SunOpta is a company based in Minnesota. It makes plant-based beverages, fruit snacks, protein shakes, other products like that. It does have a facility in Ontario's Niagara region as well. SunOpta beat earnings and revenue estimates in its first quarter. So for more on what's driving growth in this segment, let's go to Brian Kocher, CEO of SunOpta. Brian, thanks for your time today.
Thanks for having me.
We've seen other companies at this point eliminate guidance, the uncertainty, the tariffs. You've actually raised yours. So how have you been able to buck the trend?
I think part of it is the strength of our categories. If you look at the categories in which we participate, whether it's plant-based beverage, which is growing high single digits, or ready-to-drink protein shakes, healthy fruit snacks, both are growing over 20%. Even broth and tea are growing in the mid-single digits. One is the strength of our categories. Two is the strength of our customers. Remember, we're a private label and co-manufacturing solutions provider. So the brands that we support are outperforming the categories in which they play. And both of those give us confidence in our outlook and our long-term guidance.
So let me ask you about tariffs. Are they affecting your input costs at all?
You know, a little bit. The preponderance of our revenue is in the U.S. Input costs, we have some that we globally source. As you mentioned in your intro, we have a facility in Niagara on the Lake, which we import product to the U.S. So we have a little bit of that. What makes our model different than maybe some others is we traditionally pass through raw product costs. As costs go up, we pass along raw product costs to customers. As they come down, we reduce prices to customers. So in our world, this is a normal conversation that we're having with customers, and we expect to recover substantially all of the tariff costs.
Are there a lot of fluctuations in your input costs, generally speaking?
Not too much. I mean, in general, we're sourcing agricultural commodities, so we do have a little bit of flexibility and volatility from season to season. I would say it's a little bit smoother than volatility, but it's significant enough that we have those conversations with customers and pass along either the cost or the reduction in price. How
big is your Ontario operation, and how does it fit into the grand scheme of what you do?
It's one of our fruit snacks facilities. We have two better-for-you fruit snacks facilities in North America. We have about 90 employees there in Niagara on the Lake, and they do a fantastic job for us. We export the preponderance of that product in the U.S., so we have a little bit of tariff impact with that, but we count on it as our growth engine. That healthy, better-for-you fruit snack category is growing more than 20% annually, and we've posted 19 consecutive quarters of double-digit growth, and we couldn't do it without our team in Ontario.
So do you worry about being a costlier option in times when, of course, inflation is very much a concern for North Americans?
Well, I think we have a little bit of insulation against that. Remember, we provide solutions for our brands or our private label customers, but we're also very versatile and very diverse. So we play in food service, in club channel, in traditional retail. We service customers that might be in premium food service or in QSR. We do out of home. We do private label and brand. So really, wherever the shopper needs us, you can find the brands that we support in our products. I think the other aspect of that is many of our usage occasions are not economy dependent. They're medicinal, they're lifestyle choices, they're taste preferences. In many of those cases, they're enduring tailwinds for consumers to stay in the category. I would never say we're not worried. We always are concerned about what goes on with the consumer, but we really like the tailwinds on our categories and believe they last for many years.
Okay, so let's talk about 2025, 2026. What expansion plans do you have, if any? What hiring plans do you have?
We're really excited about the capacity we're creating in our own network. So SunOpta did a fairly sizable capital expansion about 2 years ago. And so we're in the phase where we're driving efficiencies out of our existing assets and creating capacity to serve customers, which allows us to expand margins. I think we see our capacity being able to support revenue growth well into 26, maybe into 27. But after that, certainly for revenue in 27, we would look for capital expansion. We certainly have room in our facilities to add a manufacturing line. So I wouldn't see us with a new greenfield plant, but I'd love to come up to Ontario and add a new manufacturing line when the timing's right.
I was going to say, you talked about plans to improve productivity in your earning call. What does that look like?
The way that I would think of it, to make it really simple, is we want to create more units every hour of runtime. Now, we can do that by equipment maintenance. We can do that by confirming the settings. We can do that by direct labor training. All of that has a positive impact in the number of units per hour that we can produce. The other area that we're really making progress, including in Ontario, is our raw product yield. So how do we use raw product more efficiently so that we can actually create more finished goods out of a set number of raw products? So both efficiency of equipment and labor, as well as raw product yields, are keys to us driving better efficiencies and increased margins.
Okay, because you guys are doing well, what are your share buyback plans?
It's really interesting. We just announced an authorization to buy shares back. I want to be clear. We've got a capital allocation priority that first is deleveraging. I think getting to 2.5 times EBITDA is a really wise move in the environment, and it prepares us for flexibility and success in the future. After that, we would absolutely say growth CapEx would be a higher return on capital, but there's a subtlety to that, Morello. Right now, we don't foresee or envision growth CapEx, so that gives us a chance to be opportunistic. And when there's a dislocation in the market, we now have a share repurchase authorization plan that allows us to another tool in the toolbox to create shareholder value.
Very quickly, because I'm running out of time, 30 seconds or less. What are the new products sort of in your lines or in your industry?
We definitely see expansion in ready-to-drink protein shakes. We see expansion in fruit snacks, mostly flavor profiles in both of those. But we see consumption growing more than anything else, and I think that's the biggest area for growth.
Brian Kocher is the CEO of SunOpta. Brian, thanks for your time. Thanks for joining us here on The Close.
Thanks so much for having me. Really appreciate it.